Hey everybody, so today we're going to go ahead and break down my trade that I took on NQ that ended up making me $1,500 across all five of my Top Step XFA accounts. So this is the screenshot for the trade, and then we're going to go ahead and break it down on TradingView. And then here is just quick proof of my five XFAs that I took the trade on. So first and foremost, we're going to be looking at the hourly chart here, and the reason we're going to be doing that is because this is the time frame that helped me determine my bias going into the day. If we take a look at Tuesday, what ended up happening was we had CPI, and we had that CPI manipulation wick above Monday high right here, okay? And then we kind of just teetered off here the rest of the day. But then overnight, what we ended up doing was this displacement. So this is a 5 a.m. candle going through the previous day low. So this displacement candle went through previous day low. And if you think about it, why would you expect this gap to inverse? Because I think the popular thing right now within ICT trading is looking at inversion gaps, and you're anticipating every gap to be an inversion gap after it takes liquidity, when that's not always the case. This gap right here, do you think that this would be a manipulation or would it be a market structure shift? And I want you to think about the formation of the candle. And obviously, in hindsight, we can see it was a market structure shift, not a manipulation candle. Manipulation candle looks something a little bit more like this, where it's a big wick down and we begin to see that movement higher, right? This right here is a strong displacement through previous day low, creating a fair value gap. But what else do we have following that? Because again, we're not just looking at gaps and imbalances, we're looking at what is the draw on liquidity. Well, seeing this, it helped me determine that all of these lows right here look really good as a draw on liquidity because they're daily lows and they're relatively equal. Also listed right here, you can see RTH low. If we head to the RTH regular trading hours, all of this is relatively equal, and this big gap right here is unfilled. So whenever you have a big gap unfilled that's resting below a bunch of sell side, that's going to act as a huge strong draw on liquidity and a big magnet on price. So that is pretty much the main reason how I determine my sell side or my bearish bias going into the day. So let's jump down to the 15-minute time frame now and talk about the things I use to collect clues to further strengthen this bias and why I wanted to go short. And I just want to mention that this is the same process that I do every day to the point where I know it like the back of my hand now, and that's very important to implement within your trading plan. Is you need to be doing the same process on getting your bias and taking your trades every single day. The hourly I use to determine my bias with structure, right? What hourly PD arrays and what does order flow look like on the hourly time frame, and then is the 15-minute time frame supporting that? And I use the 15-minute time frame to determine my pools of liquidity, and that's going to be primarily session liquidity and equal lows or highs. Um, I always start out on the daily chart, but I'm going to save that for last because that's actually where the real secret to how this whole engine runs. And I think if it's something that you haven't seen before on my channel or uh, ICT's channel, I think it's going to be a super big light bulb moment for you in your trading. But getting into it, 15-minute time frame right here, again, it's what I use to determine my session liquidity. And I use a indicator just to get a really quick overview, just so I can see it very quickly. Asia equal highs up here, London high right here, and my pre-market and data high was right here. So this is your pre-market high. Anywhere from your pre-market range is from 7 a.m. to 9 a.m. So you're going to look for the highest high and the lowest low within that range. So right here starts 7 a.m. You can see that was the lowest low. And then up until the opening bell, which is right here, this was your highest high. So 7 a.m. to 9 a.m. So that was your pre-market range. So I always have that, have those pools of liquidity marked. Now, with my bearish bias, obviously we have very smooth session highs up here and pretty smooth, relatively equal highs at London up here. Now, that doesn't mean all of a sudden I'm going to switch my bias to bullish, but what it means is if I see signs after the opening bell of a potential structure shift bullish, well, then I can frame longs, right? I have valid targets. But as structure remains bearish, I have to stick to my bias and look for all of these lows to be met first. These will be met at a later point in time, but you have to think about what is the next draw on liquidity and what is structure supporting. So that is what I use the 15-minute time frame for. Let's go ahead and dive down into the 1-minute time frame where the trade was taken. Now, if you're an ICT trader and you traded today, I'm going to go ahead and take a wild guess that you did something like this, or this is really what your strategy relies on, right? 9:30 a.m. opens, we go lower. We take out this pre-market low, right? And now all of a sudden we have this fair value gap right here. What just happened? Inversion fair value gap right here. We have equal highs right here. You go long. You have to have this huge stop. That risk to reward is not very great, so you have to try and aim for something here. That's still not good. That's only a 1-to-1, and then you have to aim for something maybe all the way up here. But then all of a sudden, that gets taken. You think life is great, and it comes down and just bites you, right? So I want to talk about why I still stayed firm with shorts, and it's going to be derived from two things: the daily time frame and the opening range gap. And I use those two variables to determine the quadrants. So quadrants are the biggest part within my trading besides draw and liquidity, but quadrants help me determine the validity on which fair value gaps, which order blocks are going to work. So let's talk about it here. So I have the daily time frame here to the left now, and then on the right hand side we have the 1-minute time frame right after New York open, where I think a lot of people started to get tricked, right? Because I think the initial start to the morning was tricky if you didn't have a solid sense of conviction on where the market was going. So first things first, what are these quadrant levels? Well, the daily wicks that we see within this range are extremely important because what they're going to help you do is, again, verify which PD arrays are going to work. Now you're going to want to use the longest wicks and the ones that go the furthest, and I'll tell you what I mean by that. So obviously this right here is the day that we're trading today. It was a big down day, right? But before we made this giant move lower, we got to take a look within the last 20 trading days. So I'll save you the time of counting. This is day 20 right here. So that is your 20-day look back on your IPTA range. But I'm not looking at all of this over here because right now it's not relevant. Right now, at this point in trading, we are within this range right here. And what's within this range? Well, it's a lot of long daily wicks. We're not at the previous day wick right here, right? Because we're trading well below that. So if you take a look at, as I'm hovering over this area where the trade is forming, you can see 20, 25, 71675. Look on the price level right here. You can see that right around this area is where we're currently trading. So when I see that, I'm looking at these wicks right here. I see this one because it's really, really long. And then I'm looking at this one right here because it dips the lowest. It goes the lowest out of these three right here. And we're trading within that range, so it's relevant. So that's why I'm using those wicks. And what you're going to wait for is for time and price to align and for structure to align, and you're going to anticipate PD arrays forming over top of these quadrant levels. So what I did to get those quadrant levels was very simply, I just take my Fibonacci level, I start from the open. Well, technically this is the close, but I start from that level and I just go down to the wick, right? And I have all four quadrants. So that's your 0, your quarter, your 50, your upper, and then your 1. Right, so all four quadrants right there. And you want to wait for PD arrays to form over those levels because they are going to be the ones that are important. So now that we have that established, next thing I want to take a look at is the opening range gap. So looking back at the 1 minute chart, if we go down to the bottom right hand where it says ETH, we're going to click on that and go to regular trading hours. This is going to show you where the close was yesterday, so 4:14 p.m. because stocks don't trade overnight, right? This was market close at 4:14 p.m. and then we open at 9:30 a.m. right here. So this is regular trading hours, and you're going to want to look at the characteristics of this gap. So we can see that this gap is very large. It's 175-ish handles. And we want to do the very same thing. We want to mark the quadrants of that gap. So we have previous day settlement, the 75 level. I already have it marked, but I'll do it again just for the sake of this video. Start from there and go to the 9:30 open, right, which is right there. And then I have a little thing that's already pre-made, but I like to make it dashed right here. And those are my levels. So it's this gray and this green, right? So I have my upper quadrant, my middle, and my lower quadrant, and then my 9:30 opening price right there. So this is straight from the 2024 mentorship. I'll show you right here. I already have it set up. And what I can do is, since I have all of my notes, all I have to do is do Control F, type in something that I want to find, and then it takes me right to it, right? So opening range gap right here. If we're bullish and price gaps up in a premium and fails to reach 50% of the opening range gap, it means it's very bullish. So what do you think that means if we're looking for sell side delivery? If price opens up and we're bearish and we gap in a discount, like we did right here, this is a discount gap, and we fail to reach the 50% level, that means it's very bearish. Okay, so let's use that logic going into today and how you can anticipate very weak and fast price action. We know our bias is for sell side delivery until the 15-minute time frame shifts structure and we look for something bullish after the higher time frames like the 15-minute and the 1 hour are starting to look for bullish signs. But we know that the 1 hour is bearish. We already went over that. It's very bearish, right? So we're on the 1 minute now and we're sticking with that bias. We're not letting these little 1 minute candlesticks completely change our outlook on what the higher time frames are telling us. So we open up and we first take sell side delivery. So what does that do? Well, let's take a narrative. That's enticing people to initially go short, breakout sellers, and then people who see this gap and want to sell that weakness, but they're going to get punished, right? Because we open up, take sell side, and then we go higher. So we take buy side right here. Why do we need or not need to go take this pre-market and data high? Because something that's very popular among ICT traders is they want to see that data high get hit, right? This is probably an A plus setup for a lot of you. Inversion fair value gap, data high. And it's not bad, but I think it's very pattern tradey because you're not adding that narrative and higher time frame bias to your trading. You're just trading a pattern. What we're doing right here is we're taking buy side and we're going up into the midpoint of this long, look to the left, this long daily wick. So when we're grading these wicks and we're grading these opening range gaps, the midpoint is extremely important to look at how we react. Are we rejecting? Are we displacing through it? Are we failing to reach it? If we're bearish, we don't want to see this get taken. Why? Because remember what we said about the opening range gap. If we can't even go reach the 50% level, this is the 50% level of that opening range gap, that means we're very bearish. What do we have right here? We have two quadrant levels. And when we have two quadrant levels that are pretty much overlapping like we do right here and we do right here, this is going to be a very strong point of interest in how we react here. So what we've done is we've taken these equal highs and we're jamming up into these two quadrant levels, the opening range gap lower quadrant and the midpoint of this long daily wick right here. That is where we reject and make the high of the day. Notice how before we went and tapped that, we go down here and touch this quadrant level, which is the upper quadrant of this daily wick. So you can see we're using that as real support and using that as real resistance. I'm waiting for this type of reaction because what is this doing? It's confirming to me that bearish algorithmic signatures are there. I'm seeing delivery off of quadrant levels, and now I'm seeing inefficiencies, gaps, and order blocks be made over top of my quadrant levels right here. So you can see now we're trading back below these two quadrant levels and the opening range gap low, which is that 930 opening price. And this is where the trade forms. Okay. So one, we have this reclaimed SIBI. We have this that we can treat as an inversion fair value gap. And then we also have this SIBI right here. So I'll just leave this on and we want to draw them right, see how we have a little gap volume imbalance right there. So we want to include that. We don't on the bottom, so we're good right there. So that is your real SIBI. Now notice how it's not overlapping these two quadrants. So when I'm using these quadrants, I'm very, very disciplined on what I want to see. They need to be overlapping the gap that I'm looking to trade, or the order block I'm looking to trade. So since these two quadrants are not overlapping this gap, I'm waiting for this order block to be made. I'm waiting for price to further prove to me that bearish algorithmic signatures are there. Keeping in mind that our draw on liquidity is all right here. So once we create this up close candle and trade through it like this, this to me is your real order block. This is where the entry was based off of. Why is it a real order block? For a couple reasons. First, it trades up into this SIBI right here. And does it reach the midpoint? No. The wick, which does the damage and the bodies tell the story, the wick can't even reach the midpoint. The body can't even reach the lower portion of the fair value gap. And then the very next candle trades through that opening price. So what that tells me is that price is extremely weak, and this is a valid order block. The next thing is this order block is overlaying two daily quadrant levels. See the 1 and see the 0.25. The 1 is this daily close, and the 0.25 is the lower quadrant of this long daily wick. So it's overlaying two extremely important levels right there, and we get displacement through, and it's having bearish algorithmic signatures over this gap right here when we reference the consequent encroachment or the midpoint of that. Okay, so many things right there within price action alone. And the great thing is we have a really good strong draw on liquidity, because what is your high probability draw on liquidity? Equal highs and equal lows. Well, it just so happens we have a bunch of stacked daily lows right here, which is a pool of resting liquidity. This is where the entry was taken, short right here. My limit was set at the opening price right here. And then my stop loss, to be safe because we're in some pretty volatile times, was at the high right here. And then my target was Friday low for about a 1 to 1.5 R. Could have held to RTH low right here or Thursday low, but I was content with just that. I didn't want to ask for too much, and you can see we have sell side delivery right to that. Okay, and then I want you to notice how with those characteristics of that opening range gap, remember what we said, if we can't even reach the midpoint, that's telling us that we're very bearish. We only reached the lower quadrant level right here. Remember, it's that dashed line. And what did we do for the rest of the day? Is go lower. All right, so that was your first indication of extreme weakness for the day. So that is the whole breakdown on this trade right here. A lot packed into it. It was a longer breakdown. So if you made it to the end of the video, I appreciate it. Please leave a comment. Please subscribe if you found this helpful. And take care and good trading to you.